In Chapter 7, Graham gives you 4 ways to beat the market. Then he systematically eliminates 3 of them, proving even the pros can't make them work. What is left is the only strategy that actually survives: buying bargains. Hi, I am Nick, the guy with a Greek accent, a long-time value investor. The Intelligent Investor is Warren Buffett's favorite investing book. But Graham wrote it in 1949. You'll spend 3 hours on one chapter and still feel confused. In this video series, I translate it into plain English you can use tomorrow. If you are new here, start from video 1 to get the full picture. Graham starts the chapter with this. The enterprising investor, by definition, will devote a fair amount of his attention and efforts toward obtaining a better than run-of-the-mill investment result. Most people think that enterprising investor means taking more risk to get higher returns. Wrong. Graham is saying you need to devote more time and effort, not more risk tolerance. If you are not willing to do serious work analyzing securities, treat it like a business, and put in real effort, then you should be a defensive investor. Then he writes, the activity specially characteristic of the enterprising investor in the common stock field may be classified under 4 heads. 1. Buying in low markets and selling in high markets. 2. Buying carefully chosen growth stocks. 3. Buying bargain issues of various types. And 4. Buying into special situations. These are your only 4 options. Notice what is missing. No day trading, no crypto, no meme stocks. If it is not on Graham's list, it is not intelligent investing. But here is where it gets interesting. Graham immediately begins eliminating options. Strategy 1. Market timing. Graham writes, we have already admitted ruefully that the market's action in the past 20 years has not lent itself to operations of this sort on any mathematical basis. The fluctuations that have taken place, while not inconsiderable in extent, would have required a special talent or feel for trading to take advantage of them. This is something quite different from the intelligence which we are assuming in our readers. Graham writes that timing the market requires a special talent rather than intelligence. This is a crucial distinction. Intelligence is something you apply to facts and figures. Talent is like being an elite athlete. You can study the physics of a basketball for 10 years, but that won't make you Michael Jordan. Market timing is the same. It is an intuitive feel for the crowd that can't be taught. Graham's advice: don't bet your retirement on having a feeling. Stick to what can be measured. Strategy number 2. Growth stocks at full price. Everyone loves growth stocks. Buy great companies, hold forever, get rich. Simple, right? Graham writes. There are 2 catches to this simple idea. The first is that the common stocks with good records and apparently good prospects sell at correspondingly high prices. The investor may be right in his judgments of their prospects and still not fare particularly well, merely because he has paid in full and perhaps overpaid for the expected prosperity. The second is that his judgment as to the future may prove wrong. Graham identifies 2 traps with growth stocks. First, you can be completely right about the company and still lose money because the stock already reflects that growth. You are paying today for prosperity that may arrive years later. Second, your judgment of the future may simply be wrong. Growth slows, competition appears, or management disappoints. So you face a double risk. Even when you are right, you may not win, and you might not even be right. But here is the real twist. Graham continues. The investment caliber of such a company may not change over a long span of years, but the risk characteristics of its stock will depend on what happens to it in the stock market. The more enthusiastic the public grows about it, and the faster its advance as compared with actual growth in its earnings, the riskier a proposition it becomes. This inverts everything Wall Street tells you. Wall Street says, quality stocks are safe. Graham says, the same company becomes riskier as its price rises faster than earnings. A wonderful business at 100 times earnings is more dangerous than a mediocre business at 5 times earnings. Risk isn't just the business, it's the price you pay. Then the evidence. Graham studied 45 growth funds with 10-plus year track records. The implication here is that no outstanding rewards came from diversified investment in growth companies as compared with that in common stocks generally. Professional investors with research teams barely beat the index. Graham's conclusion. There is no reason at all for thinking that the average intelligent investor, even with much devoted effort, can derive better results over the years from the purchase of growth stocks than the investment companies specializing in this area. Surely these organizations have more brains and better research facilities at their disposal than you do. Consequently, we should advise against the usual type of growth stock commitment for the enterprising investor. If the experts can't win buying growth stocks at premium prices, what makes you think you can? Second strategy, buying growth stocks at full price, eliminated. Growth stocks aren't the problem. Overpaying for them is. What is left are bargain issues and special situations. But before Graham dives into those, he writes something crucial. To obtain better than average investment results over a long pool requires a policy of selection or operation possessing a twofold merit. 1. It must meet objective or rational tests of underlying soundness, and 2. It must be different from the policy followed by most investors or speculators. This is it, the complete formula for beating the market, written in 1949. Condition number 1, objectively sound strategy. Condition number 2, different from what everyone else is doing. Both must be true. If you are just buying what everyone else buys, even if it's high quality, you won't beat the market. That's consensus. No edge. If you are just buying unpopular trash because it is cheap, that's not value investing. That's being a contrarian fool. Then Graham writes, if we assume that it is the habit of the market to overvalue common stocks which have been showing excellent growth or are glamorous for some other reason, it is logical to expect that it will undervalue, relatively at least, companies that are out of favor because of unsatisfactory developments of a temporary nature. This may be set down as a fundamental law of the stock market. Graham calls this a fundamental law of the stock market. If the market overvalues what is popular, it must undervalue what is unpopular. Everyone loves the hot growth stock. Nobody wants the company with bad news. But here is the opportunity. Sometimes that bad news is temporary. A product fails. Earnings miss one quarter. The market panics and dumps the stock below what the business is actually worth. That overreaction is where you make your money. You profit by buying what everyone else is running away from. But here is the critical part. The key requirement here is that the enterprising investor concentrate on the larger companies that are going through a period of unpopularity. Why large companies? First, they have the resources in capital and brain power to carry them through adversity and back to a satisfactory earnings pace. Second, the market is likely to respond with reasonable speed to any improvement shown. Let's break this down. Graham favors large companies because they have the capital and brain power to survive a crisis. And crucially, Wall Street is more likely to notice when they recover. Small companies can stay undiscovered and cheap forever. A study analyzed what would happen if you bought the 6 or 10 stocks in the Dow Jones Industrial Average with the lowest price to earnings ratios each year from 1937 through 1969. The results? And the cheap stocks clearly outperformed the average in 25 years. 25 years out of 34, the cheapest Dow stocks beat the market. An original investment of $10,000 made in the low multiplier issues in 1936 and switched each year in accordance with the principle would have grown to $60,900 by 1962. The same operations in high multiplier stocks would have ended with a value of only $25,300. Cheap beats expensive by nearly 3 to 1. But then Graham retested this strategy on stocks bought in late 1968. This time, it failed. The low multiplier stocks showed sharp losses, while high multiplier stocks showed gains. Graham writes, perhaps the aggressive investor should start with the low multiplier idea but add other quantitative and qualitative requirements. The lesson? Don't just buy cheap. Buy cheap and quality. Don't just look at this year's PE. Look at the average earnings over the past 7 to 10 years to avoid companies with wildly fluctuating earnings. Now Graham gets to the heart of value investing. We define a bargain issue as one which, on the basis of facts established by analysis, appears to be worth considerably more than it is selling for. Let us suggest that an issue is not a true bargain unless the indicated value is at least 50% more than the price. 50% more than the price, not 5%, not 10%, 50%. Here is what Graham means. You analyze a stock and determine it is worth $15 per share. Graham says, don't buy unless the price is $10 or less. Why? Because 15 is 50% more than $10. You are buying $1.50 value for every dollar you spend. Can you find stocks at 50 cents on the dollar? Sometimes. That's even better. But Graham's minimum is that the value must be at least 50% higher than price. Why such an extreme margin? Your analysis could be wrong. Conditions could deteriorate, and the market might take years to recognize value. There are two tests by which a bargain common stock is detected. The first is by the method of appraisal. This relies largely on estimating future earnings and then multiplying this by a factor appropriate to the particular issue. The second test is the value of the business to a private owner, with particular emphasis on the net current assets or working capital. Let's unpack both tests. Test number 1, appraisal method. What will the company earn in the future and what is that worth? You estimate future earnings, what the company is likely to earn going forward. Then you apply a reasonable multiple to those earnings. For example, you believe a company will earn $5 per share annually going forward, and similar businesses deserve a 12 times earnings multiple. That means the stock is worth around $60. If it is selling for $30, that's a bargain. If it is selling for $50, it is not. But here is the trap. You are estimating the future. You could be wrong. Test number 2, private owner value. What will someone pay to buy the entire business today? This is more concrete. Forget future projections. What could you actually get right now if you bought and liquidated this company? Cash, inventory, receivables, equipment, what it is all worth today? Here is the critical question. Would you write a check to buy this entire company at today's market value? Not just 100 shares, the whole thing. If the answer is no, if you wouldn't want to own the business at this price, then why you are buying pieces of it? The difference between the two tests, test 1 bets on the future and test 2 looks at what exists now. Graham likes test 2 better because it is harder to fool yourself. When you ask, would I buy this entire business at this price? You are forced to think like an owner, not like a speculator. He then continues. Thus, we have what appear to be two major sources of undervaluation: currently disappointing results and protracted neglect or unpopularity. Graham identifies two reasons stocks get cheap. First, disappointing results. The company reports bad earnings, loses a major contract, or misses expectations. The stock gets punished. Second, neglect. Nobody is talking about it. No analysts cover it. It is boring, unglamorous. The stock drifts lower simply because no one cares. Both create opportunity. The market is fond of making mountains out of molehills and exaggerating ordinary vicissitudes into major setbacks. Even a mere lack of interest or enthusiasm may impel a price decline to absurdly low levels. The market loves drama. A minor problem becomes a catastrophe. A normal business cycle becomes the end of the world. Graham says the market makes mountains out of molehills. It exaggerates everything. Even worse, sometimes there's no problem at all. The stock just becomes boring. No excitement, no story. And that boredom alone can push the price very low. This is the emotional overreactions that creates bargains. Now here is how Graham finds undervalued stocks. The type of bargain issue that can be most readily identified is a common stock that sells for less than the company's net working capital alone, after deducting all prior obligations. This would mean that the buyer will pay nothing for all the fixed assets, buildings, machinery, etc. Let's break down what this means. Net working capital is current assets minus all liabilities. Current assets are things a company can convert to cash quickly: actual cash, marketable securities, inventory, accounts receivable. All liabilities mean everything the company owes: short-term debt and long-term debt, preferred stock, accounts payable, everything. If the stock's total market capitalization is less than the working capital, you are getting every building free, every machine free, every patent free, the brand name free, and the future earnings free. You are paying less than the company would be worth if it shut down tomorrow, paid all its bills, and sold off its current assets. If a company has $100 million in current assets and $40 million in total liabilities, its net working capital is $60 million. If the entire company sells for only $45 million, you are buying $60 million in liquid assets for $45 million and getting all the factory's equipment and future earnings for free. Why does this happen? The market panics. Bad news hits. Everyone dumps the stock. The price falls below any rational floor. This is where fortunes are made, when fear destroys logic. Graham tested this. He bought 85 such stocks on December 31st, 1975, and held for 2 years. The gain for the entire portfolio in that period was 75%, against 50% for Standard & Poor's 425 Industrial. What is more remarkable is that none of these issues showed significant losses. 7 held about even, and 78 showed appreciable gains. 78 out of 85 winners, 0 significant losses, 75% gain versus 50% gain for the index. This is Graham buying actual stocks with real money and documenting the results. But here's something critical. He says on a diversified basis, you need 15 to 20 stocks minimum to make the statistics work. Later in the chapter he writes, however, neither of these causes disappointing results or unpopularity, if considered by itself alone, can be relied on as a guide to successful common stock investment. Just because something is cheap doesn't mean it is a bargain. He should require an indication of at least reasonable stability of earnings over the past decade or more. No year of earnings deficit, plus sufficient size and financial strength to meet possible setbacks in the future. Buy cheap companies that have stable earnings over 10 plus years, no years of losses, and sufficient financial strength. Graham also addresses secondary companies, companies that are not a leader in a fairly important industry. After the Great Depression devastated smaller firms, investors developed a permanent bias toward industry leaders, causing secondary companies to trade chronically cheap. Graham writes, "This had meant that the latter group have usually sold at much lower prices in relation to earnings and assets than have the former. It has meant further that in many instances the price has fallen so low as to establish the issue in the bargain class. Here is the paradox. A good secondary company might be just as profitable as a blue chip, but trades at a massive discount. They offer high dividends, reinvested earnings, acquisition premiums, and massive upside in bull markets. The critical rule: buy them only at bargain prices. Why? The average market value of a detached share is substantially less than its worth to a controlling owner. You are not buying control, so you need a discount." Then Graham looks at special situations. The exploitation of special situation is a technical branch of investment which requires a somewhat unusual mentality and equipment. Probably only a small percentage of our enterprising investors are likely to engage in it. This isn't for most people. Special situations involve corporate events, mergers, acquisition, bankruptcies, reorganizations, spin-offs. To profit, you need to read legal documents, understand corporate law, predict regulatory outcomes, and calculate complex arbitrage spreads. It is specialized work. Graham estimates only a small percentage of enterprising investors will do it. Unless you are willing to become an expert in this narrow field, skip it. Strategy 4 also eliminated. Graham concludes with the most important part. There is no room in this philosophy for a middle ground or a series of gradations between the passive and aggressive status. Many, perhaps most, investors seek to place themselves in such an intermediate category. In our opinion, that is a compromise that is more likely to produce disappointment than achievement. No middle ground. You are either defensive or enterprising. Pick one. He continues, "As an investor, you cannot soundly become half a businessman, expecting thereby to achieve half the normal rate of business profits on your funds." Graham says, either you treat investing like a business, doing real analysis, putting in real time, making real decisions, or you don't. There is no middle ground where casual efforts get you casual returns. A business owner who works half-heartedly doesn't get half the profits. They get nothing. Same with investing. You are either all in as an enterprising investor or you are defensive. Pick one. Anything in between just wastes your time and money. It follows from this reasoning that the majority of security owners should elect the defensive classification. They do not have the time or the determination or the mental equipment to embark upon investing as a quasi-business. Most people should be defensive investors, not because they are incapable, but because they don't have the time or determination to treat investing like a second business. And there is no shame in that. Now, here is the proof that this actually matters today. Jason Zweig in the commentary writes, "A great company is not a great investment if you pay too much for the stock. Look at the evidence. From 1995 to 1999, General Electric, Home Depot, and Sun Microsystems grew beautifully. Revenues doubled or tripled. Earnings soared. These were objectively great companies getting greater, but their stock prices rose even faster than their earnings. By 1999, General Electric traded at 48 times earnings, Home Depot at 74 times, and Sun Microsystems at 98 times earnings. What happened next? From 1999 to 2002, all three stocks collapsed. General Electric fell from $52 to $24. Home Depot fell from $69 to $24, and Sun Microsystems fell from $39 to $4. The businesses didn't collapse, the valuations did. This is Graham's point in living color. The quality of the company and the quality of the investment are two different things. That's Chapter 7. In Chapter 8, Graham introduces Mr. Market, and Warren Buffett calls it the most important chapter in the entire book. It is where you learn the single most powerful mental model for understanding stock prices. Once you get Mr. Market, you'll know exactly when market crashes are opportunities, not disasters. If you are finding value in this series, subscribe so you don't miss Chapter 8. Click here to watch that video, or click here to start from the first video of the series. Thanks for watching. I'll see you in the next one.